Hey, this is Trader Travis with take 3 of this video. No, really, this is my 3rd attempt. I am here with day 4 of my 30-day challenge. And if you're first time watching this, I challenge myself to show up consistently, at least for the first 30 days of 2020. And I wanted to provide a piece of valuable content for you each day. Quick recap, day 1 was where I shared my MTO goal setting strategy that my wife and I use each year. Day 2, we talked about dates, how to avoid bad stocks. So we talked about Macy's. Macy's is a bad date, declining stock and declining revenue. And then we talked about Apple Computer, which was a good date. Their revenue is increasing and their stock is increasing. And you want to think of stock ownership as like dating someone. You want to date a good person with good character, right? So you can, at least give yourself a chance of having a high probability of having a successful relationship. And then in day 3, I talked about, how do we find these good dates when they're, young, like avoid the cheap stock trap is what one of the videos was called. How to avoid cheap stocks like Macy's, but find cheap stocks like Domino's Pizza that pulled up on my hot stock formula back in 2010 at about $12. And now that stock is at $294. So how do we find stocks like this? And that's what I talked about in day 3. Now in day 4, this is in honor of John, one of my one-on-one clients. He had been asking me, hey, can you share your rules for investing in stocks? And I said, well, I'll get around to it because I said, I just don't want to give it to them. I was like, I think it's going to be valuable for other people. So I said, give me a sec because I want to share it with everyone else. I meant one-on-one clients, but I was like, you know what? Let me just share this with the community. And the reason why is because, honestly, I don't really support most investors investing in individual stocks. I am at my core a passive index fund investor. So I always encourage people to not invest in stocks. And I mean, one simple reason, if you think back, if you've been investing for 10, 20 years, think back to the things that have caused you the most pain with investing. And I think, like me, my experience was, picking individual stocks, right? Knowing how to, and then being good at it. And one of the best I've seen is the Can Slim method by William J. O'Neill. And that's one of the best I've seen. But here's a problem. It takes, well, I won't say it's a problem. That's an inaccurate statement. Problem for me because it takes more time and effort than I'm willing to put into it. So when I started one-on-one coaching for the first time in about 10 years, I used to one-on-one coach before I came online. I was both surprised and disgusted at how many people own stocks. And I'm like, really? As much as I poo-poo on stock ownership in the Success Academy, I was surprised to see so many people own stocks. And I was like, oh, I can see why, because if they told me, I would have been like, no, bad, right? No, honestly, though, I would have been like, seriously? Because again, at my core, I'm a passive index fund investor, and I think you probably can't go wrong just investing in like broad-based ETFs like SPY and things like that. But when you get to individual stocks, you run into a lot of problems. They cause a lot of challenges. So again, I decided, you know what? Let me just give everybody my 5 rules of stock investing. But again, I want to keep repeating myself. Just because I'm giving you rules for stock investing, don't think I am co-signing on your decision to own stocks, because I'm not. Because I don't think people should invest in stocks unless, one, you spend a lot of money at the company. Tony Robbins is one who helped me with this mindset shift. If you own an Apple computer or iPhone and you don't own the stock, you're being a consumer. You're helping Apple get rich, and yet you're spending money, right? That's how consumers don't, I won't say, it's hard to be wealthy as a consumer, but it's easier to be wealthy as an investor, right? You own iPhone, but you invest in a company stock. Not only are you helping that company get rich, you're helping yourself get rich, right? So that's one of our criteria. We invest in companies that we shop at a lot and things like that. Criteria for number 2, if you're dead set on investing in stocks. 1 was, hey, you should spend a lot of money at the company or at least be buying their products. If you're helping that company get rich, then you should be getting rich with them. Second rule is if you want to put in a lot of time and effort like Warren Buffett does, right? Because Warren Buffett is a pro, and investing in individual stocks is a profession. So you should spend the time. Do you spend weeks and hours each week reading annual reports, staying on top of what the company is doing? Do you interview the CEO, or do you even travel to their headquarters? Or are you like most speculators, just buying things based on what you think and then you hope it works out? Like, hope is a horrible investing strategy, right? So anyway, everyone is not me, and I get that. So I was like, fine, if you're going to invest in stocks, here are some rules to make sure you at least don't blow up your account in your face. So let's start with rule number 1. Only buy assets, right? I get the definition of an asset from Robert Kiyosaki. An asset is something that puts money in your pocket. A liability is something that takes money out of your pocket. So how does this look when it comes to stocks? Basically, only buy stocks that pay a dividend, right? Preferably, again, stocks that, you're helping them become rich, like stocks you shop at, like Apple, Costco, things like that. So that's rule number 1. Only buy dividend-paying stocks. Because, again, if it doesn't pay a dividend, your only investing strategy, the only way to make money is if the stock goes up. And that's an investing strategy based on hope, right? And hope is a horrible investing strategy. So even if the stock is declining in price, at least if it pays a dividend, you're still being paid. You're still making money when a stock falls in price. It's one of the many ways to make money when a stock falls in price. Just own a stock that pays a dividend. Okay, rule number 2 here is let's back up here because I missed a bullet point here at rule number 1. Why did Netflix crash in price and Apple did not? Duh, I should follow my own bullet points in my own little sheets right here. So we can look here just as a 5-year weekly chart of Apple, and then we look here at Netflix. Okay, and Netflix had some trouble here and it declined in that same time period. I think it went down like 30-something%, but Apple did not. And if you're wondering why, here's my theory based on my many years of investing, which not really a theory, I've just seen it play out over and over again. Okay, Netflix here. The revenue is increasing. That would be a good date based on the revenue. It has good character. They're actually making money each year. So if you buy the stock, it's not really a bad thing, except it breaks the first rule, right? Only buy assets. It's not an asset. The revenue is increasing, so it's a good date, but it's not an asset, so it violates my rule. There's no way in the world I would buy this stock. We've talked about it as a family, but if the stock doesn't pay a dividend, we're not buying it. There are other ways you can profit from this stock without actually buying it. Don't buy it, right? Spend $1,000 on a call option instead of $30,000 buying 100 shares of stock. Simple as that. If you think Netflix is going up in price, then buy a call option on it, a long-term leap call option. There you go. You still benefit when it goes up, but significantly less risk. And if it crashes in price, you lose $1,000 versus losing $15,000 or $30,000, right? It's not an asset. I don't put my money in there. And there's other strategies you could use, but that's just one. So anyway, Netflix's revenue is increasing. So it's going up. It's a good date. Not just going up. It's a good date. Apple's revenue is increasing also. But Netflix crashed 30% in price and Apple did not. And if you're wondering why, here's why. Let's come here to the summary page. Netflix pays a 0 dividend. None, right? And again, based on my years of experience, here's what I noticed. When stocks fall in price, stocks that do not pay a dividend, PayPal, Square, Netflix, they crash, really crash. Other stocks, dividend-paying stocks, will fall, not crash, but they will fall in price. Then that increases the dividend yield. The dividend goes up when they fall in price. Then the bargain shoppers come in and buy it because they want that dividend. Here's why. We come here to the holders of this. The number 1 holder as of now in the recording here is Vanguard Group, 331 million shares. Okay, let me show you this on a calculator. 331, 132, 509. Apple currently pays $3.08 dividend per share. So $3 per share. You own a share, 1 share, you'll get paid $3.08 a year, right? Dividend income. So this is how much Vanguard gets paid in passive dividend income each year from Apple. $1 billion. As my 4-year-old says, tink, tink, tink. You own a stock that's declining 40%. Netflix. That's a date. You're dating someone who adds no value to the relationship. They don't bring in any income. They don't help you out in any way. They are useless. All they do is take from you. Netflix or Apple. Wow, this partner is contributing to the relationship, whether it's income, physical, whatever. They are adding value. To the tune of $1 billion a year. They're paying me $1 billion a year in passive income. And it's declining in price. So flipping what? I'm earning $1 billion in passive income. Which stock do you think you want to own? Netflix or Apple? That is why stocks that pay a dividend don't fall usually as far as stocks that don't pay a dividend. Moving on here, because I am way past my 10-minute limit and I still have 4 more rules to cover. How about I do this? You know what? Because sticking to my 10-minute limit is more important to me than covering all these rules. So you're going to have to come back for part 2. I will cover 2 more rules. I will try to be swift. And then I will just record a second video to share my remaining rules of stock investing. All right. So rule number 2 here, no more, emphasis on no more than 10% of your net worth goes into any individual company stock. And so, for example, if you had $100,000 net worth, when I say net worth, I'm mainly thinking of your money that you're putting in the stock market, right? You want to split it up. And then you're going to put no more than $10,000 in Apple, you know, and if Apple had a $20,000 profit, then that one stock bumped your net worth up by 20%. But successful investing to me, it's just a game of risk management, right? If you look at the most successful investors, they're not the ones who make the most. No, that sounds stupid. If you look at the most successful investors, they're the ones who manage risk better. And thus they make more money than everyone else because they manage risk better. So successful investing is really about, you know, professional risk management, being good at managing risk. And this helps you here because, again, one stock, yeah, it increased your net worth by 20%, but because you only risk 10% of your net worth, no one stock can make you go bankrupt. If Apple went to 0, you still have 9 other stocks there, you know, helping it out. Okay, next rule here is balance your risk. And the reason I wanted to cover this with rule number 2 is because they go together. You want to keep your investing dollar amounts the same when you're investing in stocks. It helps balance your risk, and so your risk is not disproportionate and all over the place. And this is even if you get an odd number of shares. I'm talking to you option traders because I used to do the same thing. When I started trading options, I got stuck on the 100 share thing. So anytime I bought stocks, I wanted to make sure I either, you know, had increments of 100 shares, 200, 300. No, forget that. It's all about balancing your risk. And the reason why is that the example I gave here is if we had $10,000 invested in Apple and $10K in Netflix, right? And the reason you want to do this is to avoid this mistake that happens to a lot of investors, and it happened to me. It's you want to avoid this. Boo, I had a 10% loss on Netflix, but yes, Apple returned 40%. And that's close to accurate, right? So percent-wise, you're up. You lost 10, up 40. Nope, because you didn't balance your risk, you're actually losing money. And that's what comes to the next point. You had $10,000 tied up in Netflix. So that 10% loss is really a $1,000 loss. You only had $2,000 tied up in Apple. You believed in Netflix more than Apple, so you put more money in Netflix. And it wasn't even an asset. Doesn't even pay a dividend, right? You're not even following what the professional investors do. You should have put 10 in Apple and 2 in Netflix. But anyway, all right, 2 in Netflix, $2,000 in Apple, 40% return. It's only $800. So yes, you're up percentage-wise, but you're down dollar-wise because you didn't balance your risk. So sorry for going over my 10-minute limit today, but I will be back with part 2 of my 5 rules of stock investing. You take care. I hope this added some value to your life. See you in the next video. Bye-bye.